Hi, Steve Van Metre here, and welcome to your weekly economic update. We take about 30 minutes every Friday to try to make sense of markets. Yeah, I think they're making sense to me, and hopefully when we're done, we'll make a little bit more sense to you. Now, I want to start out with our Q&A section because I got a ton of stuff to cover. And for those of you that have been asking me to cover gold or gold miners, yes, we're going to do that today. And I got a ton of stuff to show you. I'm kind of excited because I'm not even sure where this video is going. But let's get right into the question and answer section. If you have a question for me, you can send me an email, send me a message on Facebook. I realize on YouTube the comments are blocked. I just don't have time to go through those every week. So if you do me a favor, I will not answer trading questions. And don't message me, say, should I buy or sell this? What do you think of that? I cannot give you discretionary trading advice. This is not what this channel is for. So don't bother, because my license and liability insurance says no, and so does the disclosure that's linked below and at the end of the video. All right, question number one: should I buy TLT or any security that you show? And the answer is no. Why would you invest based on what someone puts in a video on the internet? That's absurd. You should do your own research. Now, if you are looking for a trading channel or someone who does provide advice like that, there are people that do, then they do it for a fee. And if you would like a recommendation, send me a message and I'll point you in a direction of someone's service I've actually subscribed to for a year, because I was curious to see what a trading channel is like. And that's where they give you specific buy and sell targets pretty much on a regular basis. All right, next question from my new friend down in the LA area: should I buy a house? No, not at all. You shouldn't. And one of the things is, when you're buying an asset, whether it's stocks, bonds, a house, gold, doesn't matter, you want to buy low, even if you're not selling, but to have the opportunity to sell high. But so many people do it wrong. Now, I have a great respect for the real estate industry. One of my good friends is a realtor. I know he's probably watching this video right now. And I would never think of buying a home without a realtor. I would never think about getting a loan without a mortgage broker. But one of the things that I find challenging is they're a very interest rate sensitive industry, and yet they don't fully understand when and why to do stuff. So what I want to take a minute and answer that question: is it a good time to buy a house? But I want to educate those of you who are in the real estate or mortgage business on how to better advise your clients. I mean, wouldn't it be cool if you had a client that was, owned a lot of rentals, and you could say, hey, this is a time where we need to scale back on your risky rentals, maybe sell them and consolidate into something safer that's not as volatile, because a recession is coming. I'm going to show you how to know that. I mean, wouldn't it be cool as a mortgage broker maybe to tell a young couple, hey, this is really not the best time to buy a house. You should save up your money. Well, here we go. So this is the S&P Case-Shiller U.S. National Home Price Index on the Federal Reserve website. Totally free, so you can go in there and look that up. And then I have the 4-week moving average of initial jobless claims. Now, you kind of look at this and say, well, yeah, there's kind of a relationship there. Let me help you see that. We can go in here and invert the jobless claims like so. And voila. Now it makes sense. When jobless claims start to rise, obviously, and they're inverted, home prices tend to fall, with the exception of kind of after the dot-com bubble. So what do you think is going to happen now that jobless claims next week are expected to be over 1 million, with Bank of America predicting 3 million people out of work? Do you think this is a good time to buy a home? No, because if you know anything about the industry, people that don't have jobs don't get loans, can't buy homes. And that means prices are coming down. You say, well, Steve, I'm not convinced. Okay, I get it. How about this chart here that tells you the 3-month Treasury bill, which is the proxy for the federal funds rate? It's not, they do have the funds rate on here, but this chart's all the way through. And you can see when the Fed stops, or when interest rates stop rising, which is consistent when the Fed stops tightening, you see that home prices start to peak. And as they ease, home prices tend to fall. That happened here. It didn't happen here, but I'm going to tell you, it's going to happen here as the 3-month T-bill rate is pretty much gone to zero. It's not updated here yet. So that tells you want to be a rock star in the real estate industry and tell people, hey, don't buy homes right now. Hey, because you're self-employed like me. I get it. And what's the best way to build your client base? By being there at the right time with the right advice. So when everyone else in your industry is knee deep in the recession with bad advice, your clients are looking at you and say, hey, they're the right person. They have the crystal ball. And now you do too. Okay, next question. What about those so-called bond gurus? There are two of them. I won't name their names. Who say quantitative easing causes rates to rise. I think they're wrong. I think they're completely wrong. In fact, I will mathematically prove it to you. How about that? That's pretty cool, right? I can mathematically or algebraically even go up a level, not plus and minus. We'll use some bigger math to prove to you that quantitative easing is deflationary. Now, the reason I don't listen when they talk, these big bond gurus, is you have to be careful. On one side of the fence, they manage a mutual fund. Odds are you don't know this, but on the other side of the fence, they're managing a hedge fund. And a hedge fund gets paid a manager gets paid a lot more, well, maybe not right now, than a mutual fund manager. So you have to be careful. You don't know what side of their mouth they're talking on. Odds are they're talking about the one that makes them the most money. But let me prove to you by going back to the Federal Reserve website. We'll click those off. This is the money multiplier, and you take the M2 money stock and divide it by the monetary base, and I've had to multiply or divide by 1,000 to make the numbers look right. But here's what this is. If you were ever, well, I'd probably do it as an adult, so I say as a kid, ever skip rocks across the lake? It's kind of fun, right? You find a nice little rock, and you try to see how many times it skips. In the financial world, that's the money multiplier. And what it means is how many times money exchanges hands before it dies. And how does money die? When it goes to the principal value of a loan. So if we go back and look at this relationship, you can see the reason inflation was persistently high in the 80s is the money multiplier was 11. They couldn't stop it from moving. It was going all over the place. And then you can look at in the 90s, it cooled off a bit. It was only moving around 8 times. And even in the 2000s, it's held steady. But all of a sudden, the great financial crisis changed that whole event. And what happened? It crashed down to 4.7, 4, 3, all the way down to 2. So when money is exchanging hands at a slower rate and dying, it's not inflationary. Now, when the Fed tightened monetary policy, they got it up here. They actually did create inflation because what they did is they shrank the monetary base. So the money supply was rising, the monetary base was falling, and what happens? They got this up to almost 5 times, 4.5, a little over 4.5 times before money died. But this drop here is deflationary, or you could say disinflationary. Either way, it means money is moving slower. And that is not what inflation is. This is inflation. So let's go here and add 10-year treasury yields. And we can go on there, add the data point. And we'll move it to the right so we can see them together. And slide this over so we can see. So there you go. You can see right here, yields crashed as the money multiplier was falling. And this is really important to understand because the Federal Reserve does not control the money stock, but they can raise and lower the monetary base by tightening or easing. So when they sell bonds from their balance sheet, which is quantitative tightening, I don't even know if you can say quantitative anymore because it doesn't seem to mean anything. But nevertheless, quantitative tightening means they're lowering the monetary base, which means the money multiplier rises. But when they raise the monetary base by buying bonds, which they are right now, they cause the monetary base to go up. And if they get it to go up fast enough, which they will, they kill inflation. So what Treasury yields here are telling us is the Fed is going to kill inflation. Treasury yields are just predicting that the Fed is going to have to do so much quantitative easing, they're going to permanently kill inflation. So that's how you can algebraically know that QE is deflationary and why bonds are the easiest trade in the world when the Fed is buying. The easiest, because you know what's going to happen. Do you think the Fed is going to stop easing? No, maybe not for the rest of your life is how bad this is going to be. To the extent I will predict now that they are going to destroy the banking system. There are going to be very, very few banks left at the end of whatever this mess is going to be. They might even be nationalized to the extent where the money multiplier is probably going to be 1 or less, where money will enter the financial system and then immediately die. There will be no inflation. There will be massive amounts of debt, and the Fed will be in a permanent easing mode. They will literally just have to just blow money into the economy, because every time they do, it'll just die. It'll go dead. Whereas back in the 80s, it went out and it flew around and switched around and had a good time. But because the Fed is chasing inflation and they don't have, they have the tool, which would be to reduce their balance sheet and raise rates. But if interest rates went up, that would crash the economy. Now it would reset it, and eventually we would get used to that. But they don't want to do that. So they think easing is good. Easing is deflationary. And now you know you can algebraically prove it. So when the Fed eases, why did I tell you share with you for the last 3 years, the smart money was buying bonds, and people laughed at me. Said, you're an idiot. Well, the smart money bought bonds. Don't look so dumb now, do they? All right, so next question. Who is the retail investor? When I say in the video, what is a retail investor? That's anyone who is directing their own investments. It could be they personally invest their money. It could be that they're directing their financial advisor. So a retail investor could right now be calling their financial advisor, hey, I want to liquidate everything because I'm not happy with how it's returned. So anybody who is handling their money, they're always buying high and selling low. And it doesn't matter whether it's stocks, bonds, real estate, gold, oil, you name it. They always buy at the wrong time and sell at the bottom. They always do. What's this thing with currency swaps? All right, the dollar is running out of control. We're to say we're in a dollar shortage is an understatement. We're in the largest dollar shortage in the history of the dollar being in existence. And the Fed contracted world dollar liquidity, as we've talked about in prior videos. And then due to a sequence of bad decisions or just not understanding how the monetary system works, we killed more dollars. Now, there's a massive shortage, and why this matters is because there's a lot of dollar-denominated loans. In the United States, I would not go down and get a mortgage denominated in euros or renminbi or Deutschmarks or yen. I know Deutschmarks don't exist, but you get the point. But I could, in another country, I can get a dollar-denominated loan, not perhaps as a mortgage, but as a business, I can get a dollar-denominated loan. Well, when there's a shortage of dollars, I have to sell assets or anything I've got to get those dollars to pay my debt, because in a debt-based economy, what matters more than anything? You paying your debt. And the important thing to understand, in a debt-based economy, by design, there's never enough money to make all the payments on all the debt. So if everybody in the world tomorrow said, I'm going to take all the money I have and pay against all my debts, the global financial system would implode, then explode, then go supernova, because it would be dead. There's never enough money to pay on all the debts. Ever. So the Fed not having the tools to solve the problem, because the solution to a dollar shortage would be literally to print dollars and give them to people. They say, well, Steve, you can't believe that. I'm just telling you how the system works. I'm not telling you what I think, my personal beliefs. I'm just telling you that's what they'd have to do. But the Fed can't print dollars. They're legally not allowed to. And if they did, they'd hyperinflate it, so it wouldn't matter anyways. So they've opened these currency swaps, where they haven't done since the great financial crisis, but it's not what you think. So if a country comes in and says, here, I'll give you my currency for dollars so I can take care of my dollar liabilities, I still have to pay that dollar loan back. It's a loan. It's not a gift. It's not a permanent swap. It's not like, here, have some renminbi and I need some dollars and you can have those things. They're garbage. I don't want those. I'll just print some more tomorrow. Thank you very much. No, I have to pay the loan back. It's a temporary patch. The dollar is going to wreak some more havoc. And that's part of the reason why stocks and bonds have been tanking, because people need dollars and they're selling everything they can to get it. Now, at some point, which we're seeing now, the bond selling will end because the Fed is literally going to mop up this at a massive rate. but you're not going to see the dollar selling or the stocks selling in because there's a dollar shortage and the Fed can't cure it. They can ease it a little bit, but they can't solve it. Every week that passes, the situation gets worse. Because how are dollars created in the global economy when people borrow? You think people are borrowing right now? No. What's going on with mortgage-backed securities? The Fed announced something today. Yes, they did. They announced starting next week, they're going to, where is it? Here. Additionally, the desk will target purchase of at least $100 billion for the week spanning March 23rd to March 27. Well, someone who owns bonds, he's like, it's Christmas time from the Fed. So that's great news. As if you own treasuries or mortgage bonds, and not munis, not uninsured mortgage bonds, and the Fed's going to drive yields to zero, it looks like. At least I'm hoping so. Pretty cool. Okay, let's go on to the normal stuff, and let me clear some of this out of the background. This is the M2 money supply. The growth rate is up to 8.22. Well, this is telling us that the Fed, to crash the money multiplier, is going to have to buy or do so much QE to raise the monetary base. Is going to have to exceed 10% from euro. It's going to go way up. I mean, and they're going to. It's going to be impressive. The 6-month rate of change is rising. 3-month rate of change is rising. What's driving this? People are going to cash. They're liquidating and going to cash and sitting on cash. Real estate, don't worry. They'll buy bonds at some point, but they'll buy them when they're high. It's what investors do. It's what the retail public does. Real estate loan growth up to 4.61%. So there was a surge last week, and we know this was likely to happen because we've looked at all of the refinance applications coming in, so it's just a matter of time. Now, normally this would be great, but good luck trying to refi from when I'm here. Banks don't have any money at the moment. 6-month rate of change is up and rising. 3-month rate of change is up and rising. I suspect in the weeks to come, this will plummet. Commercial industrial loan growth. See, normally this would be a good sign right now. Hey, loan growth is starting to tick up to 1.9 from last year. And the 6-month rate of change is rising. The 3-month rate of change is rising. What's the problem? Corporations are grabbing cash. They're tapping out their equity lines with their banks and then going to the government for money. So this is normally good news, but right now it's going to be moot here in a couple weeks. Loans and leases at all commercial banks representing 1/3 of all loans in the country. Growth rate is up to 4.93. No surprise, we could have predicted that. The 6-month rate of change is rising. 3-month rate of change is relatively flat. This too will go off the cliff. Consumer, I mean, look, if 3 million people are out of jobs, do you think people are going to be borrowing and getting loans? No. Consumer, not to mention they got to pay on the loans they have. Credit card growth rate flat at 5.33 from a year ago. So credit cards are not being used that much, mainly because even though the Fed funds rate is dropping, credit card rates are not. Now, I want to show you why the market is not rising and is not going to have this massive recovery that everybody thinks it is. Remember, we looked at this chart before, but I've saved it because it's so very relevant. Over the last 10 years, who's been buying stocks? Corporations buying their shares back. Now, if you listen to today's press conference, you heard President Trump say he's not a fan of corporate share buybacks. He wasn't a fan of them. And he doesn't want anyone who is going to get government money to do them. Of course, we don't know how this will all shake out, but you can see they were the largest buyer of stocks. Foreigners did buy some, but not a whole lot. Toward the end, they were forced to sell. And look, households, retirees, net sellers, insurance, pension funds, and net sellers. Obviously, this is the baby boomers right here. So everyone thinks stocks are going to just jump and rally back. Well, this blue line here is going to zero because this came out today from JP Morgan's U.S. Equity Strategy and Quantitative Research Desk, and they said that after a record number of buybacks from 18 and 19, right now we're down to, it looks like 80 billion, and I'm going to guess that number is going to fall. It's the lowest level since 1998. So, and they're gone, along with the persistent bid under stocks. So, if stock prices are going to rise, you need buyers. Okay, let's get that out of the way. On to, no editing. It's fun, more fun this way for me. The Nasdaq McClellan Summation Index. I get a lot of calls. Is the market bottom? Is the market bottom? Well, no. Wait till the unemployment claims hit next week. No. But the Nasdaq McClellan Summation Index tells us we're not at a bottom. You can see a bottom when it starts to, the MACD starts to roll over, and then you kind of know your bottom. This thing is in bad shape. It's telling us liquidity is bad. We know we're in a liquidity crisis. It doesn't appear to be getting any better. And no, this thing has got further to go. How about how things are looking at the large commercial banks? And we kind of looked, I usually go over this first, but nevertheless, here we are. A little out of order. Securities and bank credit. Oh, look. What do you know? The smart money, the banks, buying bonds. Well, everyone's selling. They're still buying. And I told you, over the last 3 years, smart money's been buying bonds. There it is. Big increase in mortgage-backed securities, even as the Fed is buying them. Maybe they're buying them to sell back to the Fed, but they're buying them up. And they even bought Treasury securities, and they bought non-insured, not much non-insured mortgage-backed. And they sold, this is interesting, they sold some of their other securities, so these are not Treasury and agencies. So they sold some of these to buy more up here, because guess what? The Fed is buying these. Remember, when you invest, it's important to know who you're going to sell to. You said, well, how do you know? Well, why would I want to own bonds? I know exactly what I'm going to sell to. I knew exactly who I was going to sell to when I bought them. Not directly, but I'm going to invest. The Fed's going to buy them, not directly off me, but they're going to end up in the Fed's hands most likely, or the retail public, because they buy high every time. Pretty cool. So let's take a look. We already know loans and leases at all commercial banks rose. We know commercial loans or commercial industrial loans rose. Real estate loans rose. But look at consumers. No real growth here. No growth on credit cards. No growth on other loans, auto loans. Consumer, not in good shape. So what you're seeing is refinances and grabs at cash before the banks go away. We already looked at the money multiplier, but let's talk about gold. Because it's not the time to buy, in my opinion, at all, unless you watch one of those commercials on the radio or TV. You can't watch it on the radio, but you get my point. This says it's always a good time to buy gold or silver or whatever it is, but I don't think so. So when you look at the world dollar liquidity cycle on a year-over-year basis, so we can see we're going to start this up cycle here in world dollar liquidity. And you can see in red, this is the trade-weighted dollar. And I don't know why, but unfortunately, the Federal Reserve is no longer, it's discontinued. But I'm not worried about where it's at now. I want to see historically what happened. And you can see the dollar surged up in value. And when the dollar rises, if we switch over here to this chart with gold, when the dollar rises, it's usually bearish for gold. Usually, not always, but usually. So it tells us that there's a dollar liquidity shortage, which we have now, the worst one in history, meaning the dollar is likely to go up in value. And no, I'm not suggesting you invest in it. I'm just telling you what's likely going to happen. The Fed is going to have to massively ease to break that dollar rally, wherever it goes. How high, I don't know. And it's that time, look here, when the Fed breaks that dollar rally, you want to start looking at gold then. Somewhere at that dollar peak is where the gold will bottom. That's what you're looking for. And how about for ag commodities? So what I did is I put some of the big ag commodities in here. You can see why I like ags, not especially now that apparently there are food shortages and people are starting to figure that out. And commodity prices should rise. But nevertheless, you can see ag prices tend to rise ahead of these big money printing events. And there's no doubt with the sensitivity of the dollar, it's possible that these too strong dollar right now is keeping ag prices suppressed. But wait till the Fed breaks the dollar and you will see ag prices go up. So I like those too, just kind of coincidental to what is going on in the world. So let's get that out of the way and go on to some charts. And we'll just spend the rest of the time here We'll probably go a little longer than 30 minutes, but given what's going on in the markets, I think it's probably worth the trouble. The S&P 500 closed down near 2,300 today. Just could not find buyers as things were blowing up and forcing liquidations. And you can see there's really not much holding this back from hitting 2,100, and that would be below where it was at the last presidential election. As I said, rate cuts are bearish for stocks, and there you go. You see those little white arrows? Those are your Fed rate cuts, and in between here you have a whole lot of easing. So it's the Fed that eases that causes stock prices to crash, and you can see it there. Now, is this the bottom? Well, that's a good question. The way you can tell bottoms is normally when the retail public sells. And they haven't sold a lot yet. They're still believing, and you can turn on the financial news, which I do not watch, but you can turn it on and they'll tell you to look to buy. You're seeing articles, oh, this is buy. This has popped up today, so you should buy, and buy this and buy that. But look, here is the last recession, the great financial crisis. And you can see here's trading volume. So we're up here. Now, granted, there's more share. Well, there isn't more shares. There's just more money. So you expect there's going to be more trading volume on a weekly basis. But look, you don't see the bottom until you get this monster spike week after week after week. And what is that? That is the retail public saying, I've lost enough money. I've give up. I'm done. I'm going to sell. And then they're selling stocks, going to cash, or likely buying bonds. Why would they buy bonds? Because what does the retail public do? They buy high and sell low. You'll see all kinds of newsprint coming out at this time saying, stocks are dead. Don't invest in stocks. You're going to see dividends getting slashed to zero as companies need bailouts. Stocks party will be over. So since we're not seeing a massive amount of selling yet, that tells me that the market can go down a lot more than you think it can. How low? I don't know. But I can tell you the public hasn't sold. Let's go and take a look at bonds. Let's look at TLT, which you should not buy. Don't buy because I put a chart on here. Or I'll start putting charts on here of stuff and then you'll think that I'm doing it and I'm not, and you won't know because I can do that. Let's look at TLT. I thought this was a head and shoulders bottom. Here's your left shoulder, head, right shoulder, broke the neckline, squeezed some shorts, and I really cannot wait until tomorrow to see where hedge funds are positioned. I think they're still short, which is huge. And so you can see there's this late rally in bond prices, which pulled them way up. And what we see by breaking through here, we're squeezing out these people who have been short. Not really short sellers here, but the short sellers right in here. And so the next big line in the sand for bonds is this zone right here between these two purple lines. This is called overhead resistance. Why? Because we have sellers, 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 and then, of course, all the selling up here. This is why I believe speculators are net short, and I've already algebraically proved you we're going to have deflation. When you have deflation, interest rates go down, bond prices go up, so I expect these to go higher. So that's very interesting to me. You see this big move here under lots of volume. Another way to tell you're potentially near a bottom is when selling gets exhausted. So we see selling, all this selling. And this is the 5-day moving average of volume. And so once this exhausts, you kind of know you're probably near a bottom. And so there you go. Zeros, 30-year zeros, which generally do not pay interest because you pay a discount to buy the bond to pick it up at maturity, where you get the face value back at maturity. So if the face value goes up when you go to sell it and you bought it at a discount, you made more money. That is for someone very close to me. I can't say his name, but he'll know if he's listening to this video. I'm not sure when he does or if he does. And you can see they hit resistance here. And once they pull through, they should follow TLT on the way up. All right, let's take a look at some other things. I mean, speaking of ags with the shortage, you're starting to see a bottom forming here, and these things move up. It's kind of interesting. There's a lot of open gaps in this chart that suggest that these things will likely go up as it becomes obvious there is a food shortage. Let's take a look at gold miners since you've asked for that. Let's do that. Again, I think they're headed lower, a lot lower, and I believe there will be a time and place to buy them. but you can see there's a lot of volatility here. They're closing right here underneath this resistance level in the middle blue or in the purple line. And it's traded as low as it was down here back in 2015. I suspect we're going to break below these 2015 lows. I just have a hunch. It's just my guess. And looking at the junior miners, we see a similar situation, just massive amounts of volatility, huge price swings every day. And it got down also to its 2015 lows. I have a hunch it breaks that as well. Like I said, just have a feeling. It doesn't mean I'm right. It just means I have a hunch. One thing to be concerned about is emerging markets are painting a very bad picture here. We broke below this purple line, which has been an area when we have market declines that needs to be a sign of support. And right now it's below that. It's acting as a sign of resistance, meaning there's a much deeper dollar liquidity problem coming that's going to lead to a purging, not just of emerging market stocks, but of the broad market, because emerging markets is a proxy of liquidity. So if you don't have the NASDAQ or anything else, what this tells us is there's still more selling to come unless something saves this and turns it around, and it certainly does not appear that that's the case. Let's take a look at the dollar busting out at 102. Again, this is just a wrecking ball of the markets as the world chases dollars to pay on its debts. I mean, this is a big problem, and the Fed does not. All the Fed has is tools to slow its growth a little bit, but it can every week. This problem goes on, the dollar's going to roll higher until the Fed, if you think 100 billion of mortgage-backed security produces a lot, wait till they turn the big dollar or the big QE engine on. I mean, they're blowing a lot, but you wait. Let's take a look at the oil companies, which are getting crushed. Chevron down here at the tail end of this support zone here. If it doesn't hold, Chevron stock's probably going to be down 40s. ExxonMobil has been finding support, or trying to find support back at its lows in 2002. If that's wild, if it doesn't hold, ExxonMobil could be a sub $20 stock. I mean, it really can. I mean, there's nothing. I mean, look at crude oil. It's today close to 23 after its high 28. Companies don't make money at 23. I can tell you that much right now. How are we doing on time? 32 minutes. So I think that kind of covers where we're at. The situation is pretty bad, as you can kind of figure out. People think all these unemployment claims are priced in the market. What you don't realize is the global economy is contracting because world dollar liquidity is shrinking. And until there is loan growth, until people can get back to work, borrow money, and spend it, what's going to happen is the global economy is going to shrink down to the available size of dollars. And it won't stop because dollars are destroyed as people pay on their loans. They're destroyed when people go delinquent on their loans, and they're destroyed when people default on their loans. And all that will happen is the global economy will continue to shrink until that all stops, which means the Fed's going to do quantitative easing at a level you've never seen before in your life. And that's how you know they're going to crash the Millennium Multiplier, create massive deflation, and you're going to see interest rates probably go to zero and maybe never ever move until they reset the system. Don't know how to do that. But there's, oh, you know what? I should have left something open here because I will look forward to seeing you back on Monday. We'll see how the hedge fund manager is positioned, see what the market brings us. But if you think we're anywhere near a bottom, I don't think so. I'm Steve Van Metre. Thanks for taking time to watch. Hope you got some value out of this. I'll see you Monday. Bye now. The content of this video is provided as educational information only, is not intended to provide investment or other advice. This channel is not to be construed as a recommendation or solicitation to buy or sell any security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre in my own personal capacity. The opinions expressed in this video that I'm own do not reflect the view of Atlas Financial Advisors, Inc. or Steven Van Metre Financial.